Good morning and welcome to the Wednesday, June 17th, 2026 meeting of the Defined Contribution Plans Committee. The meeting is now called to order. Will the clerk please call the roll to establish a quorum?
Thank you, Chair. Member Rugani.
Here.
Vice Chair Kang.
Here.
Member Tunson is absent. Alternate Member Knox.
Here.
Member Hoekstra.
Here.
Member Gardella.
Here.
Member Levison.
Here.
And Chair Zalaski.
Here.
Thank you. I will now do the roll call for the alternate members. Alternate Member Harland is absent. Alternate Member Tran is absent. Alternate Member Anderson is here in the audience. Alternate Member Contreras is absent, and Alternate Member Bader is absent. Thank you, Chair.
I would like to remind members of the public in chambers that if you'd like to speak on an agenda item, please turn in a speaker slip before the item begins. After the item is called, we will no longer accept speaker slips. You will have 2 minutes to speak once you are called on. We will now proceed with today's agenda. Please rise if you are able for the opening acknowledgments in honor of Sacramento's indigenous people and tribal lands. To the original people of this land, the Nisenan people, the Southern Maidu, Valley and Plains Miwok, Patwin, Winton peoples, and the people of the Wilton Rancheria, Sacramento's only federally recognized tribe. May we acknowledge and honor the Native people who came before us and still walk beside us today on these ancestral lands by choosing to gather together today in the active practice of acknowledgement and appreciation for Sacramento's indigenous peoples, history, contributions, and lives. Thank you. Now please stay standing for the Pledge of Allegiance. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. All right, next up is the approval of the consent calendar. Clerk, are there any members of the public who wish to speak on the consent calendar?
Thank you, Chair. I have no speakers on this item.
Thank you. Are there any commissioners who wish to speak on the item? Murray.
We have 4 non-substantive but nevertheless necessary changes to the minutes. The very first line in the minutes, at the time the meeting was called to order, accidentally says PM instead of AM. And Ms. Jacob, I will give you a copy of what I have here. Item 4 and 5 both say the action was received, commented, and provided direction. That same thing happened on item 3, where we talked about the NAGDA award. So instead of just saying received and discussed, if it could also say received, commented, and provided direction. The direction was to have me work with Samantha on creating the award application. On item 6, there was a separate motion to select our vice chair, but there's no separate vote listed. There was a separate motion, second, and vote on that. It does say that there was a second motion, but it doesn't list the details of who made that motion and how that vote occurred. And for item 7, the motion was not just to name the people who were going to the conference. It was to authorize up to 5 people and to spend up to $12,500. So let me give you the written.
Thank you.
That's all I have, Mr. Chair.
Anybody else like to speak on the consent? All right, is there a motion and a second for the consent calendar then?
I'll make a motion to accept the consent calendar.
All right, second?
Second.
All right, so we have a motion by Brad Hoekstra and a second by Jeremy.
And Member Hoekstra, does your motion include the,
Edits from Murray, yes.
thank you.
Sorry, I should have said that.
All right, so all in favor, say aye.
Aye.
Any opposed? Any abstain? All right, the motion passes. Let's move on. All right, let's now proceed to the discussion calendar. Item number 4, the NAGDA Conference Additional Expenditures. Is there a staff presentation?
So this item, we want to be as transparent as possible. When the committee had the discussion at the last meeting about selecting and costs associated with the NAGDA conference, which is in Florida, at the time I went to complete all the registration information. There are pre-conference sessions, and after further review of flight availability to get from Sacramento to Florida on the same day to also attend at the timing of the pre-conference session, that's just not going to happen. So I actually reached out to Murray on this item just to say, this is the issue. I want to be transparent to the committee. What do you recommend? So I'm just bringing this back for the committee's awareness. And let me see, the recommendation is to have the committee pass a motion that there might be additional expenses related to those individuals who are going to attend a pre-conference session on that day, requiring one extra night of hotel costs. The committee approved 5 attendees to go to the conference. We right now have 4 attendees that are attending. So there are certainly what was approved should be covered in terms of the cost. We just want to be transparent and make sure the committee is aware that there will be some additional hotel costs for those attending the pre-conference session, because there's no way to get there in time. We checked Sacramento airport flights to Florida, and it just wasn't feasible. So I'm asking the committee just to pass a motion approving the use of the administrative allowance account funds for that additional expense associated with those participating in that pre-conference session.
Just really quick, I believe it was in the report, but this still keeps us under our budget for what we allocated anyway, right?
That's correct, yes.
Yeah.
I just think it's important at any time these funds are used in any manner that there's full transparency on that.
I agree. I think, the assumption was it was going to be 3 nights. Now it's 4 nights, so that's an important distinction. Similarly, I'd like to say that for my travel, does anyone have a problem if I pay for a more expensive hotel room but only get reimbursed for whatever the standard rate is that anyone else would be reimbursed if I cover the extra cost on my own? Does anyone object to that?
I do not.
Samantha, you okay with that?
Yes.
All right. And then the last thing I just want to let people know is in a few weeks, I expect to qualify for a companion pass on Southwest. So if anyone who's traveling to the conference wants to travel at the same time that I'm traveling and either hasn't bought their ticket yet or has a refundable fare for $5.60, you could ride as my companion, and that would reduce your costs, our costs. So that's all I have. I'll make a motion to
You guys can work that out.
approve.
All right, are there any public speakers who would like to speak on this?
Thank you, Chair. I have no speakers on this item.
Okay, any other commentary from our commissioners? All right.
I'll make a motion to authorize the,
Additional funding?
well, yeah,
Expenses.
the additional nights for the up to 5, although we only have 4, up to 5 attendees within the original $12,500. It's more of a clarification, but Does that accomplish what you're trying to accomplish, Samantha?
I'll second.
All right, so we have a motion and a second. All those in favor?
Aye.
Any opposed? Any abstain? Okay, the motion passes. Let's move on to item number 5, the review of the 2026 first quarter by Fiduciary Consulting Group and the watch status of the investment lineup. Rosh, it's all yours.
Thank you. Thank you, Mr. Chair, members of the, is it commission or commissioners?
Committee.
What?
Committee.
Okay, I want to make sure. Members of the committee, so Rosh Kuzino, Fiduciary Consulting Group, artist formerly known as Highest Group. Glad to be here. This is our first meeting back as your consultant, so thank you all again for your continued confidence in our firm. I'm joined today by Jason Davidson, who is one of the founders of our firm and also from Sacramento. So had a chance to visit with his family last night, and we'll be helping out today as necessary. But we've got a lot to cover today. We've got a lot to cover in terms of just the fund lineup and some of the items that are on there, largely in part because we really haven't done this particular exercise in terms of going through the compliance list as far as the funds for a couple of quarters now. So we've just got some housekeeping to do, and we do have a few funds that we need to talk about replacing because as you'll see, we're kind of in the holiday spirit, not in a good way. There's a lot of red and green on the compliance page that we need to clean up a little bit. So thank you, Mr. Chair. Thank you, members of the committee. What I'm going to do is just jump around our item. Is it possible to share this computer up on the screen there? Because are you all seeing, probably, I don't know if you can see what I'm, thank you, Jacob. Okay, so we're going to start off with some market commentary as it relates to, and then we'll get into the plans. And so here we are, it's June 17th. These reports, the numbers that you will see in front of you as it relates to Sacramento's plans is all as of March 31st, which is like a decade ago, really, even though it was just about, what is it, about 8 weeks or 10 weeks ago. But when this was printed, just down in the middle there, you can see U.S. large cap, S&P 500 really down 4.33% for the year. So this was printed on March 31st. The markets were at their low in 2026 on March 30th. So we're pretty much at the bottom. And you can see that number there, 4.33% to the downside. There's $310 million over our plan. So about a third is in that category alone. And one of the funds we need to talk about today, the MFS Large Value, is kind of in that category, in that neighborhood. Since this was printed, however, I have some good news. And you all hopefully are, if you've checked your accounts or you've been watching the news, you know that the markets have been pretty resilient here in 2026. That same category, the S&P 500, where we've got $300+ million of core money, is up now for the year 9.15% as of this week. This quarter has been a great quarter. It's up 14.10%. And what we've seen in the past from Sacramento participants, and we saw it in 2022, is we're a resilient lot here in the sense of, okay, a little bit of market volatility doesn't necessarily encourage folks to hit the panic button. People stay the course. And so we've seen that in 2022. That's how we got the couple $100 million in gains over the past couple of years. And hopefully that's what we're going to see as we see the account gains or the asset gains for next quarter. So hope to have much better numbers for next quarter. But as you all again know, as if you've been watching the news or paying attention, things have gotten a lot better than what you see here. I'm just going to go to the next page and show you down at the bottom here, there's a chart on the bottom left. So the S&P 500, right, that was that same category that was down 4% when this was printed, has 11 sectors or categories within that. And we hear a lot today about we are in unprecedented times. But we don't so often have charts to actually prove how unprecedented these times are. This is one of those charts, though. The bottom left there, first quarter, The best performing category in the S&P 500 should be no surprise to anyone in this room, right? $5.70 a gallon for the cheap gas here in Sacramento. Energy, right? It was up 40% for the first quarter. And then look at financials down the bottom there, down 10%. That 50% delta, 5,000 basis points, that is the largest difference for a single quarter in the history of the stock market between the best performing category and the worst performing category. So truly unprecedented times that we are in. Just scrolling through a couple other pages, and then we'll get specifically into Sacramento data. This chart here, geopolitical conflict going back to 1950. And so when this was printed, so at the bottom row there, you can see US, Israel, Iran war. We didn't quite know what the outcome was going to be. I mean, we still kind of don't, but we have a pretty good idea. It's pretty well crystallized at this point. We're up about 14% since the conflict. And if you just look on the right-hand side here, and we certainly don't want conflict, we don't want war, but gosh, capital markets seem to respond more often than not in the green when it comes to conflict. So what is that saying, war is good business? I mean, that's just kind of a terrible saying, but this chart sort of proves it to a degree, at least as it relates to capital markets. And then this is just one of those time in the market versus timing the market. Again, Sacramento participants do a really good job of staying the course. But going back to 1990, if I was in that S&P 500 and just stayed there, I'd get 10.7% return. But if I lost the 15 best days, I'd be probably the unluckiest person in the world. However, my return would cut down by a third, and then you can just kind of see that stair step down from there. So there was a lot of uncertainty when these reports were printed, and we've again had a lot of, I think, answers to some of the questions that were still unresolved even just 10 weeks ago. Here we're looking at, we've talked a lot in this room about rotation, right? It's been for so long, it's been, and this is going to be a theme too as we talk about replacing the funds here today. There's been growth, there's been high-flying stocks, technology, the Magnificent Seven, U.S. markets. That's just been a consistent theme for 5+ years now. And there's been pockets of small caps. Now we see some international emergence. But in terms of styles, what about value versus growth? What about energy and financials versus technology and communications? And so what this chart shows us is even though we've had that surge in energy for the quarter, it still hasn't caught up to growth. And I wish the folks at Morgan Stanley would come up with something better than blue versus blue to try to make a point as it relates to two different styles of investing. However, the top one here is growth. And you can just see there's been times of pretty significant dispersion between growth and value. And then it's tightened, but value just has not been able to overtake growth. And so it's interesting to just see that style has still stayed growth, growth, growth. And now, of course, since March 31st, it's really picked up. And then the last comment I just wanted to make as it relates to our plans, and we'll get into our plans, is this is the quilt, right? We look at this on a regular basis. And if you go all the way to the left, that's from 2010. All the categories here, that's the return of each of those categories. These are primarily the categories in our plans. There's a couple of exceptions. Commodities, for example, really is not a category in our plans. You can get to it through the brokerage. But you can just see on the right-hand side there, so that's the first quarter, look at commodities, 24.4%. And then the next best performer, mid-cap, 1.2%. So huge difference. And then it's like, well, wait a minute, why don't I just jump into commodities? But then if you go back and you look what's kind of generally down in the bottom, it's commodities, right? A client had made a really interesting point, I thought, and we've got a lot of money as it relates to target date funds. If you were to take the target dates and assign them one of these categories, it would really be this global balance category. And look how it kind of almost looks like a belt, right? Just sort of holding everything up. There's an exception here in the first quarter, but I bet by the end of this year, it'll be somewhere in the middle again. And so we've got, now we look at Sacramento's plans, right? So we've got about $200 million in that kind of red block category, and that would be the asset allocation, the Vanguard target retirement. So these are the funds that we potentially could talk about as it relates to one of the items on today's agenda, the CITs. And so overall, $929 million as of March 31st. Are we over $1 billion, John Stagel? We're just under $1 billion as of now. So we're right there.
That's calculated, we're right around 97, about 970.
970 billion for the record. That's good. I didn't, if it was $1 billion, I would have felt bad because I didn't bring balloons. So we're getting there, everybody. We're close. Top left, you can see fixed income, $200 million. And then the majority of that is in the Nationwide Fixed Fund. That fund, we've had some discussions in this room about that fund, right? The rate of return on that fund around 2.4%. Sluggish. But now we've got our Vanguard Money Market Fund that you all voted to add a few quarters ago. You can see about $3 million in there. Rate on that's over 3%. So participants that aren't necessarily getting what they should out of a capital preservation fund in the Nationwide Fixed now, thanks to you all, at least have the money market fund as an option.
Rosh, what I see on that page is when you add up the percentages that are in the three funds that we're considering replacing, it's about 11.6% of our assets. I don't see that as a problem, but I just took note of that will have an impact on our participants in a positive way.
Yes. When we made the fund lineup overhaul in 2021, we impacted 58% of the lineup then. So, and it was significant, but I don't know, Murray. I mean, you were on the committee then. I don't know if there was a lot of like negative feedback as it related to that kind of change. And we are going to see potentially, if you all.
I didn't hear it. I don't know what's with Samantha heard things back in the office when we made the big change in November of 2021 and overhauled 20 or 25 out of the 30 funds in our lineup, remapped them to something else.
I couldn't hear the first part. Was there?
Did you experience any kind of negative feedback from employees after that happened?
The only negative feedback I received was from one individual related to the one fund.
Contra fund.
Which I also, the same individual has provided additional feedback over time, and I have to remind the individual that you also have to pay attention to what's going on in the market, right? Like, things go down, things go up. It's not specific about one fund being bad in the circumstance in which the individual, I said, the market's down this percentage. I'm uncertain what you think would be happening in this fund. Oh, well, I don't like it when my money goes down. I just want it to always go up. So that's all I've heard.
We're being asked to replace funds that are underperforming their
That's
benchmarks.
correct,
right?
Ash.
Yeah.
Yep, that's right.
Yeah.
And they're also, and we're following our process, we're following our investment policy, you'll see all of that. Yeah, but that's right. So the funds that are underperforming are in, so first one up here, MFS Value. So about $56 million, 6% of assets. And that's the largest of the three. And then the other fund, or the other two funds, the next one is the American Century Mid-Cap Value. This fund has kind of been a chronic underachiever. It was on watch, off watch in 2023 or so, and then back on watch again over the past year or so. $14.8 million in that fund. And then the last fund that we're looking at potentially replacing here, I just got to scroll down a little further. It's another MFS fund. MFS stands for Massachusetts Financial Services. It's the MFS International Diversification Fund, about $37.2 million, 4% in that fund. The good news is we don't do a lot of fund changes here. We did change the Vanguard Growth Fund out for JP Morgan large cap growth. But really, other than that and the big fund overhaul that we've had, it's been consistent for our participants. So that's what you want, to try to minimize that disruption. But to your point, Ash, it's like at some point, though, if they're underperforming, that's our job, right? To be like, okay, we got to get something else for you so that you can make more money here.
And we certainly don't want you and your company to fear coming to us with requests to make changes when it's appropriate. That's what your contract requires you to do.
So I'm going to skip ahead here to the compliance page in our report, our quarterly report. And so this page is synchronized up to our investment policy statement. And what I mean by that is, if a fund underperforms its peer group and its benchmark for the trailing 5-year period, and that's all stated out in the investment policy statement, it gets a red dot. If the fund is red for 2 consecutive quarters, we place the fund on watch, again, per the investment policy statement. If there's been 4 quarters consecutive where the fund's been on watch, where the fund's been red, out of compliance, then we have the option, we don't have to, but we have the option to go out and find a replacement for that fund. And so the 3 funds that we're talking about today are all beyond the 4 quarters of being out of compliance. And so you all can see when funds were placed on watch. So back to the nationwide fixed, you may wonder, well, why can't we talk about suitable replacements for that? That is the one fund in our lineup that is tied into the low record-keeping fee that Nationwide also provides us, that 1.25 basis point record-keeping fee. And so to have such a low record-keeping fee, Nationwide doesn't give us as high a rate of return as they would if the record-keeping fee were higher. And so the way we look at it is there's only $100 million in there. And so in terms of overall allocation, it's only about 11%. So we feel as though why not get the lowest possible fee for as many participants as we can? And that's why the record-keeping fee is as low as it is. And the Nationwide fixed account crediting rate is also low. We can't, if we unplug that and we replace the Nationwide fixed fund, because Nationwide makes revenue off of the fixed fund, with another fund, then that 1.25 record-keeping fee goes up to like 7 or 8 basis points for everyone. So this particular one, we're kind of stuck with it on the Nationwide fixed. There's another one there in case you're like, what's the fixed elite? That fund is specifically for the PEP plan. It's very similar to the fixed, a little bit different in terms of the rate, slightly, but it's very similar to the Nationwide fixed account. MFS value, you can see, 4th quarter 2024, American Century 2nd quarter of 24, MFS international diversification. We also have a recommended action here today, everyone, not to replace a fund, but to place the fund on watch, and that is the Vanguard International Growth. So this is the 3rd quarter. Again, we sort of missed it last quarter. We weren't here. This is the 3rd quarter where this fund's been out of compliance. So our recommendation is to place this fund on watch. It has been hitting some headwinds based on its regional allocation and based on where the fund is invested. It's a little bit more growthy. Overseas, it's kind of been the opposite. Values outperform growth. Here in the US, as you saw by that chart, it's been the other way around. So as we look at our funds, and we'll just take a little bit deeper dive in just a moment, but MFS value, so why is the fund, kind of on the chopping block here today? You can see for the quarter, it's in the 49th percentile. For the 1 year, it's in the 87th percentile. I don't want to be in the 87th percentile. I want to be low. I want to be in the 13th percentile, because what this means is I'm just beating 13% of my peers. And then versus its benchmark right here, the Russell 1000 value, you can see down 5.7%. So there's 2 strikes. And then really the key metric, everyone, is the 5-year number, and it's not so great there either. And what's important too is if we look at the trailing 5-year calendar years, this is kind of like, okay, is it going to get any better? And there's just no real periods of compliance for this fund where there seems to be a light at the end of the tunnel. And that's why on that $56 million or so, okay, it's time to make a change.
Hey, Raj,
Yes,
I
Brad?
have a question about
Sure.
about the benchmark for that fund.
Yes.
How do you, is that the top performing fund in that category, or how do you arrive or choose that one, or how does that work?
Yeah, so the benchmark would be any funds that are, so the Russell 1000 value are going to be stocks that are like energy, financials, all those, about 1,000 or so stocks in that particular index. And so all the funds that try to beat that index are going to be in that category. And then their goal as active managers, MFS's goal is to say, hey, Brad, I got you this much more than the index got you.
Okay.
And so in their case, unfortunately, you can see, you go along that navy blue band, that's the return for MFS value, like 5-year, 8.62, which isn't bad. If I'm a participant, it's like, okay, but, right, this is our role, right? Where if I just put the money in the index itself and didn't have anybody manage it, 9.43 would have been my return. So you're not getting me my money's worth. And so then you can see it drop down another row. We're at 81 basis points below, 0.81%, and that places us in the 74th percentile. Does that answer your question?
I was just kind of wondering, is Russell 1000, is that the benchmark for that particular category?
Yes.
Okay.
Yep.
I was just wondering how you came up with Russell
Yep.
1000.
Yeah, because we want to make sure we've got all the apples in the apple truck, so to speak, and the
Right.
oranges in the orange
So
truck.
the next one's the S&P 500
Yep,
index.
that's the blend. And then look at, here you go, right? Russell 1000 growth. So that's going to be where all the Mag 7's going to live, right? So the NVIDIAs and all of the world.
Russell's an index provider. Russell's an index provider. Most large cap value or large cap growth managers will use that benchmark as the benchmark to beat when they're an active manager, meaning we're paying them to beat that benchmark. And then, you didn't ask this specifically, but the peer group that we're using, the U.S. large value or the U.S. large growth peer group, which is in that gray portion there, is Morningstar's peer group. And again, the managers that are managing your money on an active basis, meaning we're paying them to beat, understand that they're being benched to these two things.
That's like an industry standard.
Industry standard. And also it's in your written investment policy statement. So in a way, we're also processing it via policy. So it's kind of like regardless of what benchmark you manager decide to follow, policy for us is to follow this industry standard benchmark.
It might be a remedial question on my part. I just want to try to wrap my brain. There's a lot of information here, so I'm just trying to understand it all, the bigger picture of it. Thank you.
So the others, you can see American Century Mid-Cap Value, the 5-year number on this one, 58th percentile. You can see underperforming its benchmark. And it had a great 2022, but just not been good since, really. Mediocre at best. And so, again, this is where it's like, okay, it's time to look for something maybe a little bit more consistent for our participants. This is the one that has about $14 million in it. And then MFS International Diversification, 5-year number on this one, you can see again, 65th percentile. So had a good 2024, but back to that whole comment about if you go back the past 5 years, what is in that cake, right? There's not really a whole lot of glimmer in there. There's just this 24th percentile year. So one good year out of 5, and then, you know, even shorter term, not getting much better. That doesn't give us a whole lot of assurance that this fund is going to get off of, you know, or back into compliance anytime soon, which again, back to what we're talking about here today, time to make a change. Just another comment on our quarterly report, and then we can get into some of the other items here, if that's okay. Okay, I'm seeing heads nod. Excellent. You all have done an amazing job for your participants. We've talked about this in the past, but I just want to bring it up again. If I'm a Sacramento participant and I had $10,000, I was paying $43.80 in fees on that about 5+ years ago, and now I'm paying about 31% less. I'm paying $30 a year in fees. That's all in, right? That's my nationwide fees. That's all the costs. That's the plan fees as well, and then any investment costs. So all in, national average, last we saw in 2024, we haven't seen an updated number, it was 54 was the national average. We're at 30 here at the City of Sacramento, 30.1 basis points. The difference between the 43.8 and the 30.1 on our $929 million is $1.2 million a year in lower fees. And so we can't, obviously, we know, past performance, no indication future results. What can we control? We can control fees, and you all have done an amazing job at that, lowering fees for your participants, and you should be commended, which is why I always stop at this particular page. I know it's not the most exciting page, but it's kind of a great job committee page. All right, any other questions on? Any other questions on our report?
Yeah, I want to kind of make sure we're kind of continuing down this path of understanding how we're trying to achieve this concept of alpha, where we're looking for funds that outperform their benchmarks that they correspond to. One alternative to that, the dominant alternative, is to invest in passively managed index funds that have much lower costs. And so I'm just wondering, what is kind of your firm's perspective on this? I'll just say, as an individual investor, I just try to avoid actively managed funds as much as possible, because I don't want to try to, make choices about what I think is going to do well, is not going to do well. I can just track the index. And so actually, if you could go back to the slides earlier that kind of showed how certain funds were compared in their performance against the indexes. If you could go to like the S&P 500 or one of the other index funds, I think it'd be helpful for the committee to just see how it's basically plus or minus on the index, it's basically zero, It's performing exactly as the index performs, and one of the benefits of that is, number one, there's no surprises, because it's basically passively managed. It's an algorithm that drives what those funds hold, because it's designed to hold the funds that are in the index. And then, I don't know, so I'm just curious, what's your perspective on this? Do you think we have the right balance of passively managed index funds versus actively managed funds? I just love to hear kind of more about that as we kind of lead into this discussion on fund choices.
So short answer is yes, in the sense of we have an index fund in each of the primary categories. We've got a bond index, U.S. domestic, and then international index. What's interesting, and I'm glad you brought me back to this page, Ash, when you look at the Fidelity 500, it almost kind of, it's like a good way to look and see, well, where would I want to index? Look at the ranking of the Fidelity 500 index. That means that 83% of large cap blend actively managed funds cannot beat the index. And then we can scroll down and do a similar exercise for the next, mid cap. 66% cannot beat the index. Small cap, oh, wait a minute. So this is kind of maybe getting into an answer, like 33% cannot. So 67% are beating the index. So maybe if I'm looking for active management, maybe small cap, US, that's maybe a spot that I would want to look for active management. What about the international category? That's kind of a 50-50. But to your point, more often than not, especially in this bull market that we've had, it's been harder for active managers to beat the index. Great example, the fund that we added to the lineup, the trailing 5-year number, it's 1.86% below the index, and it puts it in the top 24th percentile. So still underperforming the index, but it's outperforming 76% of its peers. I guess, Jason, from a firm perspective, do we have an overall thought process on indexing?
Menu construction for us has always been to give participants like you, it sounds like, the option of indexing in every category they can, right? In the last 5 years, it's been tough to beat that type of allocation. This has been a concentrated, tech-led market that may not always exist, and it has been a tough market for active managers to add value. Our position is that won't always be the case, and that managers that are paid to outperform, if selected correctly, should. There are certainly investors across the, bandwidth of investors. Vanguard, pioneered this, that say, don't try, right? It's difficult to do, and I don't disagree with that. I will say, as a consulting firm, and that's not just us, it's, there's a little bit of an inherent bias, because our job is to try and find managers that outperform indexes. Some categories, and sometimes we do. That's just, I just want to say that. The vast majority of our clients give participants the option of having an active outperform and an index if they don't want to take that. There are some clients, and again, it's very few, that offer just indexes. But in that vein, you understand this. You will never outperform the index if that's your only choice, and that's kind of the dilemma for committees to deal with, right? Do we want to have a situation where a participant could potentially outperform? So I think, in a nutshell, that's it. Your menu looks like most of the industry menu, right? And I don't think we're, lacking in anything for somebody that wants to be able to index. And beyond that, if you want to index in style-specific categories, like I want to be all large cap growth index, you have the access to those types of things through the brokerage window. So hopefully that answers your question.
Thank you.
So we took a couple of minutes and talked about our current quarterly compliance. Wanted to skip ahead and just show everyone, there's a lot, this is an eye chart, right? But what we're looking at here, though, is going back, and again, thank you, City of Sacramento, for asking us to do this, because it does really help in terms of context, historical context for each of the funds in our lineup, so we can just see, okay, when were they compliant? When did they fall out of compliance? And this is quarter by quarter going back almost 5 years now to 2022. And so our funds that are in the penalty box, if you will, right now, are MFS value. So you can see that right here, 7 quarters. American Century mid value, that's actually 9 quarters. I thought that I recall that this one was on watch, but maybe that was just, it's been on watch for so long. That now it's at, 9 quarters? And then here's international diversification at 5 quarters. So remember the IPS, right? 4 quarters, and then we can say, okay, eject button, you're out of here. So we are well within our policy to be able to say to these funds, it's time to go.
And had we met, had you been here at the last meeting last quarter, would you have brought forward any of these for us to consider at that time?
Likely the MFS value and the American Century mid-cap value. The international diversification may have gotten another quarter, but as you all can see, it really didn't wow us this past quarter.
For me, that's the advantage of us meeting on a regular basis every quarter and having your report every quarter, that we don't fall behind and lose an opportunity to make a decision about replacing a fund, and not have to wait 5 or 6 quarters when we should have done it earlier. We can always do it earlier. I mean, the policy gives us the opportunity to make replacements at any time, but we like to follow the best guidelines in the policy, and but we don't have to.
And I would say, for MFS value in particular, you are not our only client that holds that fund. And we are replacing that fund across our clients, and they're doing it now, right? So you're at the quarter where most of our clients got the recommendation to replace it, so you're not behind in any regard.
I noticed the Naveen Real Estate is also 5 quarters at the bottom.
Yeah, that one's 5 quarters. We're of the mindset to let that one marinate a little bit longer, because if you go back and we do that same exercise on the trailing 5-year of the calendar years, there's a little bit more light at the end of the tunnel where this fund can get back into compliance. In the case of real estate funds, it's really what kind of real estate do you own? And a lot of it's been data centers. If you're underweight, so back to the AI play, right? If you're underweight to data centers as a real estate fund, you're probably trailing other real estate funds. That's the case with Nuveen. However, they are digging themselves out of that ditch, and so that's why we're like, okay, let's not hit the eject button for this one right now. So great point, great observation, Brad. This is where we do, per our policy, have that flexibility to say, all right, let's wait it out a little bit longer. Seems probably going to be the case, just foreshadowing for Vanguard International Growth. We're going to place that one on watch, but that may actually be a couple more quarters as well, because it's kind of a similar situation where it's digging itself out slowly. Okay, I know I want to be mindful.
And am I correct in remembering that you've told us in the past that your firm is actually talking to some of these you're probably talking to all of these fund managers and asking them and telling them that this is what you notice and what's their plans to improve. So you're not just waiting for the results to come through and.
That's right.
Okay.
And we've done this before. If it makes sense too, we can have those managers come and talk to the committee, where appropriate, when we don't have a packed agenda like we do today. But I think that may be a good exercise in the future, right? We're $1 billion plan. Let's have them come in and talk, right?
So far, I'm satisfied that you're the ones who are talking to them.
Well, thank you.
But, I mean, if you see an advantage to having them appear before us, I wouldn't do it just, I think several years ago, I did suggest that we do that more often. I remember looking at the agenda for BART committee, and they regularly have the funds come in and talk to them. I think they're a several billion-dollar plan. I think they don't have a Social Security, so they do some investments in lieu of Social Security. And I thought that seemed like a good idea, but I've changed my mind on that. But if you think that there's an advantage to having them come here, we certainly can.
I don't. I think we've already had the firm that I would say should come in, which is Vanguard. They've been here. And maybe we just have them come every couple of years, as long as we're still in that target date suite, because there's just so much money in there and so much money going there that I think that might make the most sense. Okay, I want to be mindful of time. I know we've got a lot still to cover here. If it's okay with the committee, can we go into the searches of the different funds? Does that work for everybody? It's part of our agenda, Mr. Chair. Is that cool? Okay, thank you. So we're gonna start off. I guess I'll just go in order of the book. They kind of are a little bit out of order in terms of where they are in the lineup, but I don't think it matters really that much.
Before we start this piece of it, though, it would help me in the future if we made the replacement item a separate item on the agenda, because the whole putting on watch and taking off watch is one set of decisions, but now we're into a much more elaborate decision-making process.
Okay.
And I'd rather have, two motions, two votes, two different agenda items, if that's possible. We don't do it that often, but.
So if I'm hearing you, I do want to be mindful of that then. We do have a recommended action as it relates to not the search documents, and that would be to place Vanguard International Growth on watch for performance reasons.
The way it's been written, we have to follow that for this agenda.
Okay.
Got one item and
All right.
one recommendation.
I can tie it all up nicely for you, though.
However, and I'll defer to the city attorney's office, you may take each piece of it and do a separate motion on that and vote.
Is this on? Oh, yeah. Correct. You mean you may make motions and amend the motions as well, so.
So more than one motion for the same item, even though it may be written separately in the recommendation?
Correct.
Okay, thank you.
As long as we remain on the topic that was noticed on the agenda. That's the only constraint.
So just to kind of make sure that we're keeping this all organized, would it make sense to go ahead and then basically consider and vote on the three that we're looking to drop? And then in turn, a separate item would be the three replacements, and take them like that?
In looking just at the recommendation, I think items 1 and 2 would be one motion, and then item 3 would be a separate motion,
Right.
which is the replacements. I think
Yes,
that's what you said.
yeah, so it's basically, yeah, exactly.
Can I clarify, is the question at hand asking the committee if they want to go ahead and do the motion on 1 and 2, and then have the discussion about 3, and then make a motion, or we're waiting until the discussion is fully complete to say, here's motion 1, here's motion 2? I feel like maybe is that part of the question right now?
Well, I think probably wait until
Okay.
they're done with everything, and then, yeah, we have all the information so we can make our decisions then.
Yep, I just want to make sure.
Everybody okay with that? Okay.
Just for purposes of the record, if we can refer to maybe numbers 1 and 2 and 3 within item 5 for purposes of record clarity, because the item are the actual item numbers, right? So you're referring to numbers within item 5.
All right, so I think we got that straight, so continue.
All right, thank you, Mr. Chair. We're going to go in order, actually, as we're talking that through. I think it may just make sense. We've talked about these funds in a specific order, so let's go through the searches in that order. Large cap value, mid cap value, international. Does that work for everybody? It's all part of item 5. I'm just going to go in that order. Okay. So the search documents are all approximately 20 or so pages, 25 pages each. They follow the same format, so it's going to start to look pretty familiar by the time we get to the third one here, but the content's obviously going to be different, right? The reason why each of these funds has struggled is going to be different, and then we've got to have different replacement options and a different recommendation for each of these. And so starting off with our large cap value fund, $55.9 million in the MFS value. It's about 6% of assets. And so this fund's been on watch since 2024. And what's been the challenge? A lot of it, there's only 62 holdings in this fund in total. So it's pretty concentrated funds. I'm sorry, 72. I knew that number was wrong when I said it. 72 holdings in this fund. What MFS does is they buy and hold, and they stick it out as it relates to the stocks that are in their portfolio. Well, what does that mean? You know, in the Russell 1000 value benchmark, the turnover in the funds around 55% of each funds that are in that category. MFS, their turnover is 10%. So that means they're like, nope, we're not selling it. We don't care if it's going down, down, down. We're going to stick it out. And so sometimes that really helps. But in a bull market where we've had all this flight to growth and your style has been out of favor and you've just been stubborn about maybe moving a little bit in that direction, not a lot, it's really hurt. And so some of the stocks that they have in the portfolio, Texas Instruments, Accenture, Nestle, Target, these are all names we know. Those are all stocks that have really created some of those headwinds for MFS. So that's listed there in terms of the overall. I just gave you a little bit more commentary than what's listed. And then our process, where you're like, well, gosh, you know, FCG, highest group, how'd you come up with just 4? How many funds are in this category? So this category has 990 funds. Exactly. So you think that money management's a big business, right? And so of those 990, how do we come down to 4? Well, some of those funds aren't even open. Some of those funds have management changes. Some of the funds themselves are being sold. Some of the funds may not be appropriate for defined contribution plans like we have in Sacramento. Maybe the fees are high. So all of those filters go in, and our team comes up and says, okay, here's your short list. So the top 3 funds to consider, I said 4 because we're also including our incumbent, for this category, large value, are Vanguard Equity Income, so that's an actively managed Vanguard fund. Putnam Large Value, so these are all apples, apples, apples. They're all in that large value space. And then Columbia Dividend Income. And so you see the ticker symbols, so we're not talking collective trust, we're talking actual mutual funds of each of these funds. And so we've got additional information coming in this report here, and I'm just going to go through. I think what we really all want to see is, okay, show us. What's your performance looking like? And we have boxed out, because there's a lot of numbers on this page, everyone, the 5-year, because that's our investment policy statement number that we need to see. And there's MFS value, again, you know, kind of looking at it just by itself, 8.62, not bad. But then if you look at that compared to the other funds that are on there, not as good as what our participants could have had. And so we start thinking about, okay, what makes the most sense here? You can see there's kind of an outlier, right, already, just in that first chart. One of these is really outperforming. And then we see versus the index, so that Russell 1000 value, how has the fund performed on the 5-year? Only one in the red, unfortunately, it's the one that we have. And then you can see the other 3 as well. And then those peer group rankings that we talked about, that silver banner that's in our report, and MFS value in the 74th percentile. And then you can see now we're talking the trailing 5-year. All of these other 3 are in the top quartile. Putnam Large Value, you can see really is a standout.
Just on those performance numbers at the top, are those net of fees?
Thank you, Ash. Yes, they are.
Got it.
So that's where Putnam at 52 basis points, MFS at 44, Putnam's, well, I'm paying you more, but look at what you're getting me, right? You're getting me 450 basis points or 470 basis points more for the additional 8 basis points that I'm paying you. You're worth your money. Thank you for asking that question. So then we just repeat that similar, those similar charts and that information, but we go by calendar year. So you can just kind of see how the funds have performed calendar year, net of fees versus the index, peer group rankings. When you see any of these outlying red, typically it's sector, you know, they might be a little bit heavier invested in financials or materials or whatever it might be, and that particular sector was out of favor that year. And so that's part of the reason why you can see some of those underperforming numbers. But what we want is we want consistency, and that's where, again, we go back and we look at that 5-year number, and all these 3 are in that top quartile. Consistency over the long term is what I'm trying to say there.
The other thing I'd add on the year over year, because it gives you some perspective, is did the 5-year outperformance come from one really good year and a bunch of so-so or bad years, or were you consistently outperforming in each of every one of those 5 years? Because you can get a good 5-year number by having a blowout year once and the rest ho-hum. And in this case, you're seeing managers that have been pretty consistent in their outperformance regardless of the calendar year we're looking at.
And on the flip side of that, Jason, I mean, you look at MFS, it's like, did they have just one terrible year, or have they had just consistently bad years? And unfortunately, it's the latter for them. And so just skipping down, I like the up capture, down capture, where it's now we start talking about risk, right? We start talking about alpha. We start talking about, okay, what are you getting me? How much risk are you taking? And then how much return are you getting me? And so in the case of the up capture, if the index makes me $1, if I just go back to that conversation about just putting the money in the index, how much are you going to make me? And so in the case, we have one fund here that's outperforming in an up market, so up capture, where Putnam's going to make me about $1.03, $1.04. In a down market, how much are you going to protect me? So if I lose $1, and you can see MFS value, okay, you're only losing me about 92 cents. But once again, you can see the others are all protecting me and my money a lot better on the downside. We take these two charts, we mash them together, and now we get this dot plot where it's like, I want to be north and I want to be over towards, you know, the eastern quadrant here. And so you can see less risk, more return, And again, there's a real outlier here. The 5-year period, and then we also, and I know this is our investment policy statement, this is key, the 5-year, but in this particular case, right, because we don't want to be changing funds out on a regular basis here, we also want to factor in the 10-year. And you can see Putnam, once again, just 5-year, 10-year. This particular chart's going to come in handy for another one of our searches, the 5-year to the 10-year, by the way. So as far as fees go, MFS value, 44 basis points. Vanguard, no surprise here to anyone, right? This is not an index fund. This is an actively managed fund, but 17 basis points. And then there is Putnam at 52 and Columbia at 54. There are CITs available for these strategies, but when we go back and look at the performance of the CITs, it's a little bit choppy relative to the mutual fund. So our recommendation would be to move to the mutual fund first, and we will continue to monitor the CITs to make sure if tracking error makes sense or not, and then potentially if the CIT does make sense, we would move into that particular product. But at this point, we don't think that they make sense. And then the report goes into sectors. So we had looked at that sector chart, right, in terms of energy, how well that did versus financials for the first quarter. So then we take the overall allocation of each of these funds across those sectors. You can see the allocation, but what I like better is what's the allocation versus the index. So again, this kind of paints the story as to what's under the hood for each of these funds. What about versus peers? And then we just do size breakdown in terms of small cap, mid cap, large cap. You can see the majority of these funds are going to be in that large cap value space. A lot of blue, right? That's our large cap. How much does it deviate? So the tighter or the smaller bar charts here means it doesn't deviate from the index too much. The bigger bar charts and MFS value, right, shouldn't come as much surprise. If we're not having the kind of turnover that our peers have, if we're just buying and holding, then we're going to look a little bit different than what the index does, because we're not necessarily moving with the index. We're not saying moving with the index is right. We're hiring an active manager. But you also start to kind of wonder, well, are you second guessing yourself? Are you maybe not making the decisions you should be making the trades you should be making? And so you end up potentially with a little bit different look and flavor to the index as it relates to that. And so skipping down, I just wanted to show you all, finish this particular search with a couple of comments on the fact sheets. So we have a fact sheet for each of the funds. It looks a little different than the fact sheets that's in the back of your report for the MFS. The multiple managers, so kind of a team of assistant coaches, been running the fund for 9.2 years on average. There's the expense ratio. The fund size is $53 billion, so it's a massive fund. These are all huge funds. But what's interesting to me here is look at MFS, what they're anticipating in terms of outflows over the next few years. And so if you're a bull and you continue to think that this is going to be an up market, if I have to keep selling stocks, then I'm going to be struggling buying stocks. And so you see that kind of outflows, 34% of the portfolio, $27 billion, little bit of a concern, especially when you only have 72 holdings right here. And then here's the allocation in terms of the style, majority concentrated in value. And then we do that similar for each of the options. And so you can see Putnam, so kind of the opposite in terms of flows. It's okay to have negative flows, but that's a bit of a tilt downwards for MFS large value. And so 108 holdings on Putnam, 72 on MFS, Vanguard's 200, I believe, 204, and then Columbia's like 80, 84. So our recommendation, you probably already know it, but our recommendation as it relates to the large value would be to recommend replacing MFS large value with Putnam large cap value.
I'm just curious, how did MFS value end up in our plan in the first place? Was that per your recommendation?
That was prior to
per
us.
CBD?
That was one of the funds out of that 42% that stuck around. Yeah, but that fund had its time prior to this run-up in the bull market. The challenge MFS has is that sort of buying and holding, and they just don't chase. Like, for example, when when you look at the top 10 holdings of some of the others, you might see an Amazon or a Google at times because they feel as though that particular stock is undervalued based on its PE and all those factors. MFS just won't do that. They're just not going to go and chase those sort of growthy stocks, and it's just really hurt them, Ash.
I have a question about the timing. If we do go with your recommendation, when does that take effect?
Roughly 60 days.
Yes, thank you.
And that's a good question too, Chi, because potentially what we, doing 11%, it's not ideal, but then it's kind of like, okay, you just sort of do them all at once, one notification instead of multiple for participants.
Yeah, they're
All right.
taking the action here.
Okay.
I will add one more thing to give you some comfort on the Putnam. Policy looks at 5-year performance period, so you're always wrestling with what good or bad number comes out of that 5-year, and what does that leave us with? Putnam has a very good cache of strong returns that will hang around in the 5-year policy period for a good period of time. And I think it gives you some level of cushion for ever having to address this fund as an underperformer in the lineup. So that's the other part of this that I like about the Putnam fund. It had the highest Sharpe ratio. I'm bringing that up, Ash, because you asked about alpha. That's a risk-adjusted return measure, and the up-down capture, as Raj pointed out, means it plays offense when the market's going up very well, and it plays defense when the market's going down very well. So there's not a lot not to like.
And Putnam is owned by Franklin Templeton, so it was part of Empower. Was Empower sold it about 2 years ago? And so Franklin is renaming some of the strategies to be called Franklin instead of Putnam. This particular fund, as of right now, will still remain the name Putnam. If the name does change to Franklin, that's not going to change the managers or the strategy or the portfolio or anything along those lines. So for now, this is still Putnam large value, but just wanted to give you that heads up that we are seeing some name changes to the Putnam family. September 11th is the fund change date, Chi. Thanks, John. You all ready for mid-cap value? All right, let's go. So this is going to look similar, but now different information. And so we're talking about the $14 million that's in American Century mid-value. Now, this fund has been on watch for a long time, a couple of years. We've been patient with the fund. It had a great 2022. If you might recall, it was in the 6th percentile. That was when everybody seemed to have a bad 2022. This fund did well. We were cautiously optimistic that as it protects on the downside, we were going to see that again in those periods of time where we've had some hiccups in the market, say first quarter last year with tariffs, first quarter this year, and it just hasn't happened. And so that's where it's like, okay, it's time to make that change. And so we've got 3 mid-cap value funds here for your consideration. T. Rowe Price mid-cap value, John Hancock Discipline mid-value, and then Harbor mid-cap value. And you can see the 5-year numbers, again, net of fees. So our fund, 7.22%, T. Rowe, just under 10%, and then John Hancock at 8.63%, Harbor, a little over 10%. And then returns versus index. So similar what we saw in the large value. And then the 5-year peer group ranking. So T. Rowe in the top quartile, Harbor in the top quartile, John Hancock, 43rd percentile. To Jason's point, maybe a little concerned if we move to this fund. Are we getting a fund that's going to end up on watch in the near future? But overall, still, though, been a consistent fund. You can see the 10-year number almost in that top quartile, and look at that 15-year number too, okay? And then here's the year-by-year calendar. So we want to see, are there any years where the fund just severely underperformed? And so it just, unfortunately, I mean, look, gosh, look at, there's our 2022 for American Century mid-value. Yeah, and there's the 6th percentile, but gosh, just went in the other direction in 2023, 95th percentile. And so that'll almost just neutralize this right here. And so you can just see the overall consistency of these other funds relative, to what we've had with American Century. A little bit of a choppy ride here. And again, this is going to be, if we're in the 79th percentile, 65th percentile, largely due to the sectors that are under the hoods for each of these funds. Okay, those sectors being out of favor that particular year.
So if we had T. Rowe Price in our lineup for the last year or two, in 2025, as a year as a whole, it was under the index and it was greater than the 50 percentile, so lower than the 50. How many quarters would they have been read on the compliance chart?
I don't know the answer to that. Because that could all been one quarter. I don't know.
Yeah.
But it would also be the 5-year number too. So, one bad year, and that's, I think, why it's important we use the 5-year number, doesn't necessarily make us, red. And so, even though we had a bad 2025, if we're T. Rowe.
Yeah, that was my error. Thank you.
Okay.
As an investment strategy, I get why people invest in large cap. I get why people invest in small cap. What's kind of the investment approach for selecting mid cap? Just out of curiosity.
It's becoming less relevant, that's for sure. It really is. It's the bridge between what you just said. It's the bridge between small and large. But like, take Palantir. How long was that a mid cap stock? A month? It just went right from small to large. I mean, SpaceX has never been either small or mid, even though it's only been around for a week. What we are seeing, Ash, and I love your questions, we are seeing some clients say, you know what if we just compressed the small and mid together and made a SMID category? So, a SMID, that's right. So I don't know if we're there yet in Sacramento, based on the fact that we have over 1% of assets. I know that doesn't sound like a lot, but we have over 1% of assets in each of the mid-value, mid-growth, small value, small growth categories. If we just had like a smattering of assets in any of those, we might want to start talking about that.
The market cap for small cap, usually the break point, there's 2 billion market cap and below is where you find small cap companies. Mid cap is 2 billion to 10 billion, and then usually large cap's kind of 10 billion and above. So you miss a lot of companies if you stay true to small cap definition and true to large cap. I mean, there is a question of whether you need them, but you do miss a pretty good subset of the market that managers would have to have some flexibility to be able to invest in. I am a proponent of smashing the two together, although, as Rosh mentioned, most clients, and I said this up front, are structured the way you are, where participants have to decide, do they want a mid-cap allocation, do they want a small-cap allocation, do they want a large-cap? We don't SMID, right? We're just going to give you one category that covers both. I think you can accomplish maybe what you're alluding to by doing that and not confuse the issue of why you need mid-cap, but maybe a discussion for another time, and that discussion kind of centers around simplifying the menu, right?
Exactly. Yeah, and I agree. It's a discussion for another time, but yeah, it just seems like we have 3 choices in mid cap, 3 choices in small cap, and it's like, do we really need that many choices?
Well, if we make the changes that are recommended in the investment policy statement today, does that prevent us from later combining those categories?
No.
Do we have to go back and amend the policy statement again to create a new category?
No. because we'd end up with a blend. We may need to take out, yeah, we may.
You would.
Yeah.
If you were going to have SMID as a category, you would have a SMID policy
Oh, yeah, you're right.
description,
Thank
a
you.
SMID benchmark, right? There is one, and a SMID peer group ranking. That one of the problems with doing that is it's a pretty small peer universe, right? So it is very subjective to single managers. You know, you could be in a bottom quartile or a top quartile by small differences from the rest of it, but you know, it is something you'd have to address in policy. But there's no timeline to it. You may decide as a committee that, you know, maybe simplifying the menu, and whether it's SMID or other things, is worth a discussion, and it'd be a project, and you know, kind of akin to what you did when you did the big revamp of funds and changing things. Are we, you know, moving down a path of putting that on the agenda for one of these time periods this year or next, whatever the period is? I think it's a worthwhile endeavor to think about, and Rosh is good at it, so.
Thanks, Jason. All right, so let's get through this one pretty quickly here, and then happy to answer any questions, but I want to be mindful of the time. So we take a look at Harbor, right, 10.34%, 16th percentile. T-Row, this is a two-horse race, 9.76 on the 5-year net of fees, 25th percentile. So right there, it's like, well, Harbor's better, right? Back to the observation question you had earlier, Ash, as it relates to what kind of risk am I taking to get the return? The Sharpe ratio tells us that. This outlier dipping way down below is Harbor, not getting me the return for the risk they are taking. And so let's look at the up capture, down capture. Sure enough, in an up market, T-Row. In a down market, yep, everybody's going to protect me, but you can see really Harbor not standing out. When we look at the 5-year number, Harbor, yep, a little bit better, but here's where I mentioned earlier the 10-year number, taking more risk, not getting as much return. And so as we go through, here's the fees for each. So our current fund is the lowest cost, but as you all saw, getting me the lowest return. So I'm not getting my money's worth for sure. In this case, or I'm not getting my fee savings worth is what I should say, how I should say that. And then the others, a little bit more expensive. And this is, you know, the overall cost. So you can see about, what would it be, about $14,000 more based on the $14 million in assets there. If we were to move to T-Row price, you know, that our participants would pay, but they'd be getting, you know, about 250 basis points more if we go by past performance. And so we also do the same, we repeat the information that I had gone through on the large value. And again, in the interest of time, I'll just kind of scroll through that and then show the fact sheets at the back here. So American Century, here we are, 116 holdings. Again, all mid-cap. It's going to be primarily highlighted in this midsection, you know, of the 9 categories. And then you can see T-Row, 123, so similar. And so recommendation for the mid-cap value is to map the American Century mid-value to the T-Row price mid-cap value. And we had some discussions at our firm about Harbor or T-Row, but our analysts pushed pretty strongly that T-Row, based on the consistency, the 10-year number, the Sharpe ratio, the, you know, risk-adjusted return, all those factors, is a better fit for the lineup than Harbor. All right. And then last but not least, we've got the international blend, MFS international diversification. And so we've got a few options there: DFA World, Fidelity Total International Equity, and then MFS again. So MFS Blended Research. So a different MFS fund, different MFS strategy here, different team running the fund, been running the fund for 7 years. Here's the trailing performance for our international category. MFS, our current fund, international diversification, I need to clarify that, 6.46 net of fees, and then you can see all the others. Now, there's a little story as it relates to this particular fund. The MFS International Diversification, the current team that's been running that fund, as far as leading the fund, they've been on the strategy for over 10 years. They've been leading the fund for the past 3 years, and it's just not gone well. Now, that fund is a fund of funds. So if I look at the MFS International Diversification, that particular allocation has 7 MFS funds in it. So it almost looks like a target date fund, but it's just international, where it's got international research, emerging equities, et cetera. And so it's a fund of funds. There's 525 holdings, though, in the fund, across the fund. And just the current team just is really not improved performance. And so based on what we talked about earlier too, and we look at the light kind of at the end of the tunnel that's just sort of seems to be dimming and dimming and dimming, might make sense to make that change. So we have the options here. So as it relates to up capture, down capture, MFS blended research is the one that's going to stand out the most here. And then you can see it really is an outlier on the 5-year, still holding steady on the 10-year. What's the difference between blended research and international diversification? They're both MFS funds. Look at the fee. 73 basis points is what we're paying now. 44 basis points is blended research. So what blended research is if we almost took, imagine if we took like a passive fund and an active fund and then got married and had a baby, you would have blended research. Blended research takes a lot of the algorithms and the computer models that you get from passive investing, but then it's come over top with active management. And so in a nutshell, what they're able to do is replicate a lot of those algorithms that you would get as far as quantitative research. You have a lot more, potentially a lot more stocks in the portfolio, but then they do take a hands-on approach. So you end up with kind of a hybrid cost in that it's not going to be as expensive as if I'm really hands-on like I am with an international diversification, but it's not going to be super low cost like an index fund. It's going to be somewhere in the middle. So the MFS blended research strategy, they actually use that across various categories, but here, of course, we're talking about the MFS blended research international. The team running this fund has been running the fund for 7 years, and they've outperformed the majority of that time. So our recommendation, and again, we go through the same information here, our recommendation, everyone, on the international is to map the MFS International Diversification R6 to the MFS Blended Research International. So, I mean, MFS probably, the diversification folks might not be so happy, but MFS as a firm, probably not too dissatisfied with our recommendation there, because we're just kind of saying, okay, we're going to move from, this strategy, the international diversification, where we just, quite frankly, have lost faith in the managers, and we're going to move over to the blended research team, which has really been running an exceptional fund for 7+ years now. We were in this is another fund that was a holdout. So we've had this, our participants have had this fund for a long time. We were in this fund when it was in the top quartile, the international diversification. But it's just kind of been this slow erosion over the past 5 or so years, and now it just doesn't seem to be getting any better. So,
Well, thank you for the summary and the recommendations. Do we have any public comment on this?
Thank you, Chair. I have no public comments on this item.
Would anybody like to weigh in on Rash's summary recommendations or anything else that you just went over?
I have some questions about the earlier part of his presentation, which is, for me, another reason to separate the two, but I don't want to lose the momentum if we want to talk about maybe doing a motion first on replacing the funds or whatever the chair prefers, but.
Yeah, I mean, I think that was a pretty good discussion, and we were able to ask him a lot of questions. If you want, we can break up item number 5 into the 2 parts we talked about, and get a motion first on parts 1 and 2, so retaining the nationwide fixed fund and the Nuveen Real Estate Security Select on watch for quantitative reasons, and then placing the Vanguard International Growth Fund on watch for the same quantitative reasons. So if we can get a motion in a second, we can vote on that.
I'll make that motion.
All right,
I'll second it.
good. All right, so all those in favor?
Aye.
Opposed? Abstain? Okay. And then we can move on to part 3. Take the recommendations of replacing the MFS value R6 with the Putnam Value Fund, replacing the American Century mid-cap value with the T. Rowe Price mid-cap, and then replace the MFS International Diversified with the MFS Blended Research.
So moved?
Okay, you can get a second. All right, we'll give that one to Katisha. All right, all those in favor?
Aye.
Opposed? Any abstentions? Okay, very good.
Can I still ask some questions, though, about Rash's piece on the report?
Yeah, absolutely.
It won't affect, obviously, what
Right.
we just voted on, but I just have some things. Let's see. So on, I don't know if your reports are consecutively numbered, but I'm on page 19 where it shows cash flow in and out of all our plans.
This is the quarterly report.
On the quarterly report, on the FCG piece of it.
Yep, right here.
Yes. So it's another quarter of net outflows. How concerned should we be about that?
You should be concerned. Typically, first quarter, though, we do see more outflows than the other quarters. I would, in this particular case, Murray, I would see how 2026 plays out. We certainly don't want to get back to where we were in 2024. If we annualize this out, you know, we're down $6 million for the year, but we do tend to see more outflows in that first quarter than we do the rest of the year. The other thing is, we did have a great number there in 2025, but that is a little misleading because that's the PEP assets transferring in from Mission Square RHS, so.
And then a question for John, jumping ahead on, John, we used to see a list of the biggest recipients of money being moved out, and I didn't find that in the report this time. Is that going to come back?
Our report is system generated, that was removed, and we have requests to add that back in. So I would.
Sir, if you could please come up to the lectern.
Yes, that was removed. It's a system-generated report. We have requests to add that back into a future version of the report because we all liked it and we were disappointed when it was taken out. I think all of the field representatives wanted back in, so there's a business case to add it back in. I can do a manual report, but it wouldn't be included in our standard report, but it will be most likely in the next, say, 3 or 4 quarters. So we'll have that added back in at some point.
Okay, back to Raj. Page 64 of your report. So, admin cost. So back in, on the top, no, the plan fee analysis page, it's got numbered page 64 on it. Yeah, so the top right on that page, Q4 of '23, it's got a $25 average admin cost? Am I reading that right?
Yes.
So that's the lowest in that period of time. That went down because we changed the record keeper for for the health reimbursement arrangement plan right around, no, we didn't change it back then. So what's happening there?
That's a combination of the nationwide fee and then the, is it $18 fee per participant? So if you turn those percentages into a dollar figure, it's $27 per participant.
And then the average participant balance, so from the fourth quarter of '24 to the first quarter of '25, the average participant balance went, let's see, first quarter.
This is likely due to the PEP coming in and the balances being lower on the PEP.
Okay.
So we're
But none of
counting
the-
them as
so
accounts.
This is all the plans all together?
Yes.
You use the same exact chart and you go, plan by plan. I don't see the difference, just doesn't seem to be there. So it went from, I don't know what was it that caused that number to change. The 107,000 average participant balance in the fourth quarter of '24.
This is when the PEP money came in. And so when you add all the PEP accounts, which are lower
Right.
in terms of average balances, then
That's the-
it's going to bring down the average account balance overall. Oops, I'm going in the wrong direction. Oh, no, I'm not. I'll just show you. So we'll take any PEP plan here. Let's see, this is the WCO, do you call it WECO? So the average balance here is $1,800 on that plan. So when we go into the 457, it's going to be north of 100,000. So when we start adding these in, there we are 8,200 on this one. This is SCXEA after, August 8th. So that's what did it in terms of the overall average balance for the fees. So the unique participant balance, and this is another discussion probably for another time because we're running out of time, but the unique participant balance is likely $100,000 and some odd thousand. We're doing it by account here. So we're trying to figure out the best way to do it. I don't know if there's any perfect way to be able to do this, but we want to be able to show the fees and how they would hit a balance. And you really do have to factor in that you have to account for that $1,800 account balance just as much as you have to account for that $100,000 account balance, even if it is the same person, right? So we're trying to do that with this chart here.
And you had a couple of pages showing how the Vanguard target date series compared to their CIT version, but we're not being asked to do anything about that at this time. So are you going to continue to just show us the differences so that we can become familiar? Is that why you're putting it in the report?
Yeah, our recommendation at the appropriate time that the city determines if it is appropriate, but our recommendation is to move from the Vanguard Target Retirement Mutual Fund Series to the Vanguard Target Retirement Collective Trust. That's our recommendation. Now, the city of Sacramento says too much paperwork, whatever the case may be, then that may be the case. But we want you to at least know what our recommendation is. And this information we have provided in the past as well. There are a couple of things to think about. There's the savings, which is minimal, $8,000 a year. But when you think about the hypothetical returns, if I had gone back and been in the CITs based on the assets, the $187 million in assets, the city of Sacramento, versus having been in the mutual funds, my participants would have had $330,000 more in gains. And that's because Vanguard pays the international taxes on the collective trusts. So we provided this 2 meetings ago. And so we want you all to have this because what gives us heartburn is we don't want you to go somewhere like NAGDA and somebody says, hey, CITs, and you're like, we don't ever hear about those from our consultant. So at least you have the information there and you can make that decision.
I can comment on the CIT. I am, in my current role, working to uplift with the attorney's office one particular document that has to be signed, which is assigning power of attorney over. And of course, you can imagine that is a concern for the city attorney in understanding what does that really mean? Like if a participant were to sue. So my goal is to be able to work through that and bring it back at the September meeting. I think it's important that they continue to show this information in the reports. It's not that the discussion has stopped. It's getting the legal analysis on what does it really mean for us as an organization to assign that power of attorney over. And that's one of the documents that's required. So that's concerning. I know that other public agencies do this, and that's part of my, I don't know the right word for that, but part of my discussions on this is happening. Other agencies do figure this
Education of
out,
the attorney's
and
office, yeah.
I believe it can be worked through, but we have a very conscientious city attorney's office that always
And I
wants
had
to be
forgotten-
careful.
Thank you. I had forgotten that we had started, or we talked about having the review started, so I hadn't heard what that was. So
Yeah, so I do,
Reminder.
you know, I think it's important that this information continues to be in these reports so that it is not appearing as if it's been forgotten about, and the work continues. I have a goal of September. I'm going to try to get that worked out.
Excellent, thank you. And then, of course, the committee still has to feel comfortable about doing that, but we'll do that knowing that if we go forward, the legal part won't be the obstacle. Okay. Okay.
So, anything else? Any other questions before we move on to item number 6? All right, so we'll move on to item number 6 and the investment policy statement.
I will start this off. This has been an item that's come before the committee, you know, several times before. I feel strongly that we are at a point that we need to update this policy and make movement on this and get this done. It's really hard for me not to call them highest group, but Rosh and Fiduciary Consulting Group did go through the document again, and I have provided in the report a red line version that includes some additional changes since the last time this came, and then of course there's a clean copy as well. It's really my goal today to hopefully the committee can work through this in a way that this, you know, a decision point can be made today and a motion to move this forward. Rosh can probably talk more about the importance for his company and their requirements, and to make sure that the clients they work with have a current investment policy statement. In a conversation I had with Rosh, you know, the prior, and you'll see it on, when it starts to talk about target date funds, I did identify, is there a way that we don't have to call out specific years in this document so that as time goes by, we're constantly having to just update a year on this, so it's a little more user-friendly in terms of the timing of constant updates, and we can get to a more regular schedule of evaluating this. But it is my hope today that the committee can come to a consensus. I understand we might have some additional edits, but it is a goal of mine and of Rosh and his team that this is updated and this is moved forward.
And
I'll turn it over to Rosh.
thank you, Samantha. What we typically see in terms of cadence is we update this every year, right? Or as needed. So, you know, if we have a recommendation to push this through, have a 2026 investment policy statement, we'll be here a year from now with any kind of updates or modifications and have a 2027 investment policy statement. Typically, what those modifications are is like if we have a SMID category or, you know, in terms of structural changes, or if there's any kind of industry changes to, like, I don't know, you know, an index used to be called Bloomberg, now it's called Barclays or vice versa, then we would make that change as well within the IPS. But we are technically compliant in how we are following the IPS, that compliance page, right? The stoplight chart that we were all looking at, that is following our IPS from 2021, but it really should be updated. Just to add to what Samantha had said, so we've kind of future fit it in terms of as vintages drop off, we don't necessarily need to modify the IPS. We also changed anywhere that it's referenced the word fund to option. So then that way, because technically a collective trust is a trust, it's not a fund. It's so umbrella term for all of those is option, so an investment option. And so that's been also changed. And that just, even if we don't do collective trusts, it's, I think, just best to sort of future fit the document that way.
And if I may add on, the overall philosophy is not changing.
That is
The
correct.
philosophy of the investment options, if you, in tier 1, tier 2, and tier 3, we're not changing that, and there's no, the overall philosophy is staying the same.
That is correct. And then the process that we follow, that we've ironed out and identified, and the 2 quarters and all that, it's all in here. So that's not changing either. So really just, I mean, this is, there are some changes here, but it's just because it's 5 years worth of changes. Next year when we do it, they'll probably be very minimal.
I do have some suggested changes. Maybe before we get into that, I'd like to make a motion that we extend the time of the meeting so we don't feel like we need to rush through this. And I think we have a couple items after that that haven't been yeah, I think our only option is to ask for an additional hour. I think Brad tried the 30-minute one time and was told, no, it has to be an hour.
Okay, well, we don't have to stay the whole hour if we don't want to.
No.
All right, so can we get a
I'll make a
motion
motion.
to extend the meeting for an extra hour so we can get all these items in?
Heard a motion by Member Levison.
So then a second?
I'll second the motion.
Okay. All those in favor?
Aye.
Against? Abstain? Okay. All right, so, yeah, proceed.
Trying to think of the best way to do this. When we had this on our agenda several years ago, I asked to make some changes to, let's see, let me find it. There's a definition of what the committee is. And in that section, summary, I'm sorry, just disconnected my mouse. Give me a second here. Okay, on page 2 of the document, there, under summary of responsibilities, there's a paragraph that has a heading of committee. In that paragraph, there is a paraphrasing of the law in the California Constitution and in the California Governance Code. I did offer some amendments several years ago to instead of paraphrasing, to actually put them in quotation marks and quote from the law so that we don't accidentally look at some language and say, well, care, skill, prudence, and diligence, that's just a lot of big words. Why don't we just use the word care? Just take the other ones out. It just seems redundant. And those words are in there purposely because they do come from the law. I'm not going to go through that today because I think we're going to be on an annual process to take a look at this, and so I'll wait for another time. But there is one word in that section that has caused some controversy in the past, and if the committee will indulge me just a few minutes, I'm just going to make, I'm going to address something, and I need to use the podium because I need to use, I need to show a document.
Yeah, I believe the camera no longer functions.
Camera works, members of the committee may use it if they need. Per council rules of procedure, members of the public may not use the document camera to display items.
Just, well, we've had some discussion before about the authority of the committee, and there's a word in that particular section. The word is advisory. It says the committee serves as an advisory role for oversight for the committee, and that has generated some concern on behalf of the city treasurer, John Colville, our former attorney, Jeff, that maybe we're doing more than we should be, even though the bylaws and this investment policy statement say very specifically that we have some authority to make changes to the investment lineup, as we did today. So I just want to give you some history on that. We had a discussion March of 2023 in this committee about the bylaws themselves. And there were some comments made at that time. I'm just going to play you the audio portion. I can't show you the video portion, but I just want you to hear what was said, and then I'll give a little bit of description after that. This is John Colville, the city treasurer.
The bylaws say that this body has the ability to direct investments, make direct investment decisions. Whereas the staff report says we're advisories to the city, to the plan administrator to make those decisions. So.
Okay, that's the first one.
Quick minute. So I'm looking at the Council Rules of Procedure, Chapter 5, D3. Chapter 5 deals with conduct of the public. Is this what you're referring to? Is that the citation is that the rule that you're discussing?
No.
Can I
Mr. Attorney,
can I
that
ask
is,
what actual citation you're discussing? Are you trying to say advisory within the Council Rules of Procedure?
No.
No, Mr. Attorney, that is
statement.
tape there for the public, so they know they're not allowed to use that.
Just statements that you're, okay, got it.
All right.
Real quick though, so you're using these, essentially comments from past meetings to
make a point.
To make a point to set up. So, but I mean, can you give us a summary of what the point is to start with, so we can use that as background and so what changes you want to make?
No, I'm not asking.
So it's kind of easier for us to connect what's going on here.
Great. Thank you for that, Patrick. In the past, there has been some statements made about the authority of the committee, and I think they were made unintentionally but inaccurately. And so I'm replaying what is a common thought about the committee, that we're only supposed to be an advisory committee. And I'm going to show you that I think that comment from the city attorney and from the city treasurer were made inadvertently, hopefully, incorrectly, so that we can correct the record. I'm not asking that at this time that we change the wording in the investment policy statement, although I would like to see it changed. But since we're talking about this section and it says that we have this advisory role, that word has caused some difficulty in the past about our overall role.
If I may, what the item on the agenda today is the
Investment policy statement.
updating the investment policy statement. A
Yes.
red line version has been provided.
Yes.
It's not about the philosophy of the committee as a whole, and we don't have the bylaws in front of us to
I'm not
go
talk-
through the bylaws,
I'm
which
not
are
talking about the
referenced. So
bylaws today. What I'm
if I
talking-
can clarify, you're not actually asking for one of the words in this section to be redlined.
Under normal circumstances, I would, but out of respect for the need for timeliness, I'm putting that aside for a later discussion. But since it's on the agenda today, and there is this thought that there is some, there's a thought out there that we're only an advisory committee, we don't have any decision-making authority. I'm using this opportunity to correct the record on that piece.
And I can opine on that. The position of the city attorney has been, I believe, going back to two city attorneys who staffed this body, that this is an advisory body. And my opinion also does not change. I just want to make that for
I'm
the
not
record.
asking you to change your opinion, I'm trying to give you some context why that opinion may actually be wrong.
Yeah, so just want to put that on the record, that the opinion of the city attorney has been consistent and remains consistent that this is an advisory body. So,
Okay. Am I allowed to continue?
Well,
as long as the matter is within the agenda, because to the extent that we're discussing what the authority of this committee is and all that, I do not think it was properly noticed. It's not an item within the agenda, so I would advise the committee to stay within the confines of what was noticed on the agenda. So what's being considered is passing a motion approving the investment policy statement. So I think any discussion as to the powers of this committee or the role of this committee exceeds the scope of this noticed agenda.
And my point is that this particular word, which is in the investment policy statement, has been the source of the controversy that has arisen about the authority of the committee. And so all I'm doing is replaying what has been said, using that particular word to create the appearance that we don't have decision-making authority and that we're only an advisory body, and then I'm going to show you something that refutes that. And then I'll be done, and we'll talk about the rest of the document that's also on the agenda, which is the investment policy statement.
I defer to the chair. The city attorney has stated what needs to be stated.
yeah, I mean, I think, you know, that wasn't agendized. I mean, we had all the red line stuff that we went over when we got it all. I mean, if along with the city attorney's office, we think that it's worthwhile going over that, I mean, we can get that specifically on a future agenda and then go over it. You know, it is something we've been talking about quite a bit over the last few years, but, you know, as far as today, everything that we have on there and everything we've been going over, you know, kind of, you know, going with what our attorney said, it's just, it's not part of what we're in here for today. But we can, if it, you know, if it's applicable, get it on a future agenda and talk about it then.
Well, the other way that I could make it more applicable is to say that I'd like to remove that word from the investment policy statement and explain why. And so I'm telling you up front that I'm not asking to make that change today, but I am asking for the opportunity to explain why in normal circumstances, I would like to see that word removed. And it's part of
Well,
the
Okay, I mean, so that's a specific action. Let's get it on a future agenda, and you can present and state your case, and then we can all decide at that point whether we want to do that or not.
Thank you, Mr. Chair.
So where were we? As far as going over the red line and the changes there, continue? Okay.
A quick question, do we have the latitude to make these, if there's any suggested changes, make them right now and also complete this document today? Is that something we could do?
Oh, I'm on. Yeah, the goal of today is to hear from the committee. I think our expectation as we worked on this was there should not be substantive changes. There might be just minor edits or, corrections with typos or that sort of thing. So we're looking to hear that and get the committee, if they can, to appoint today to pass a motion or not,
Okay, yeah, get over the finish line.
But the city is interested in getting this updated and moving it forward.
Raj, did you say that this hasn't been done in 5 years? So I would like that recommendation for it to be every year that this is reviewed for updates.
And then,
We agree, yes.
correct me if I'm wrong, but essentially, like you said, we're cleaning some things up and then combining with what you said, making it a little more flexible for us to do certain things without having to keep going in and changing the language.
Yes.
Right.
This will be a lot easier as we do it every year, a lot easier.
Right.
Just like Rosh mentioned, using the word options, removing those like 2025, 2030, as time, those specific dates, removing that.
Right.
Which can easily become out of date quickly.
Since we're doing it on the year, would it be prudent to do it at the first quarterly meeting of the year?
Yeah,
Throwing that out there.
yep.
I guess the only thing I'll add, I totally support revisiting this each year. I think bigger conversations about like the menu and things like that, we may need to have those discussions a few meetings ahead of time and go through kind of that thought process before we kind of get to a draft of what that looks like, so that the investment policy statement reflects the kind of shared understanding and intent of the committee before we get there. But with that said, I'm happy to approve the current version as proposed.
Yeah, so just really quick for a little background, like with our investment policy for the city and with SCRS, we essentially update it every fiscal year. And typically, there aren't a lot of changes unless there are things that, as you said, had been discussed, major things that would need to be incorporated. And then, of course, we go through that process and do it. But typically, it's just kind of like this. A couple things get redlined here or there. We clean up something and then, submit it for review and just go through it really quickly. So typically, we're not going to see huge changes, I wouldn't anticipate.
The idea, from our perspective, is that it should be effectively recorded in the minutes that you've reviewed it once a year. And most often, this is an exception, the changes are minor, and sometimes it's just the date, right? It's supposed to be a long-standing policy. It's not supposed to adjust with the whims, for the most part. So, yeah, the idea is that it should be a recurring agenda item to show that you guys are being prudent at your evaluation and management of the fund, so.
And then like you were talking about with going through the menu of choices and everything, if we were going to change, those are all going to fit within the policy anyway. But if we were to do something like the SMID, we may need to effectively put that in there and insert it so that,
Tier 2, yeah.
yeah. So it was recorded that we discussed it and approved it.
So can I have some questions and a couple suggestions for some minor changes? Can I go forward with that?
Yeah, absolutely.
All right, on page 5 of the document, in the middle of the page, there's a list of the categories.
Under investment options?
Under, yes, under investment options
Okay.
in section B, tier 2. We've got some different wording that's not consistent. So it says large size, mid size, and small size. On the following pages, it says large, mid-size, and small. And the glossary uses large cap, mid cap, and small cap. Is there a need for those differences? Should they be the same words? I'll defer to.
They can be the same. I don't know why they're different, candidly. Size and cap is,
It doesn't matter to me what they should, what we end up with, but if you want to decide on what, after the meeting, what's appropriate for consistency, as long as we're consistent, that's all I'm trying to get to.
So one update to reflect
Consistent terminology for the.
specific to size and cap,
size,
right?
Yes. Mhm.
Okay.
Okay. Next would be. Just punctuation. I think the word industry, the phrase industry standards should be hyphenated. If you agree, go ahead and do that. There's some number of places where that phrase appears. On page 9, on the bottom, under U.S. small company equity, there's a word missing at almost the end of the second line, by an industry standard data provider. I think that word provider is missing. It shows up in the boxes for mid-size and large size.
In the box titled U.S. Small Company Equity,
Yes,
that first sentence is what you're referencing?
yes. So right before the cross out of with the average, and right after standard data, the word provider should be added. So if you look at the same place in
I
the
would
box
need to
above it.
defer to Rosh on that sentence, on if it should have the word.
yeah, that's correct, right here.
Have the word
It's
provider?
Provider, yeah. Sorry. Oh, yeah, I am sharing again. So, that's a good catch. Thank you.
This is just a clarification, not a request for change, but on page 13, we talk about, we define what the quantitative measures are that we use when we look at the performance of the funds. We talk about where they are compared to the fund's benchmark, whether they outperform the index, and I just want to be clear that what the language says is they have to outperform their stated asset class, which means a zero difference is now outperforming. That's being the same as, so it's got to be better than a zero difference. And at one point, I think we saw a fund that was in the 50th percentile, and we told that was passing. The language actually says it has to rank above the 50th percentile. So that means it's got to show anything between 1 and 49. Is that how correct, Raj?
If it's 50, it is in compliance.
Pardon me?
If it's 50, it is in compliance.
So then it can't, then we can't use the language rank above the 50th percentile. Then we would need to say rank at or above the 50th percentile.
Are you talking about the language on page 12 or the language on page
I'm on
13?
page 13, under the top of the page, under the section quantitative measures, it defines how we determine whether they meet those quantitative measures or not. So at first it says it has to outperform their stated asset class, net of all management fees. So that's where I'm just clarifying that what that actually means in practice is it can't be the same as their benchmark. It's got to be above. And then it has to rank above the 50th percentile. If you really wanted to say it has to be at the 50th percentile or better, then we need to change the language to be consistent with what you're saying.
I think the language could change, but there's a difference between that page and that language and the page and the language on the following page, which is dealing with when you actually take action to put something on watch. The language here you're referring to is what we expect active managers to do, okay? They're paid to outperform. And we don't state outside of that we want them to beat the median manager and we want them to outperform. That is the expectation. On the subsequent page, we're identifying at what point do we consider the manager to be in violation. And in that case, as it relates to the peer group ranking, below the median is referenced. In this case, 50 would be at median. So in our reporting, 50 would not get a red. It's at median. So for watch status, we're saying this is what it takes for us to say that the fund is in violation, even though our expectations are the way you pointed it out. So slight difference between the two language styles. I suppose you can make them the same, but I think I'm differentiating between what our expectations are from the managers we picked and what criteria we use before this committee takes action to put something on watch. It's slight, but that's the reason for the difference in language.
If you're fine with it, the committee's fine with it, I'm not saying we have to change the language. I just wanted to make sure we understood what the language said and how we actually use it in practice.
I think the language is fine in terms of the way it's describing things.
And I just want to clarify that we're not intending for there to be specific guidelines for how many quarters a fund has to either fail or subsequently meet the qualitative measures before we put them on watch or take them off watch. That's on purpose. We didn't say specifically it's got to be 2 quarters, because that's not in here.
Our preference, and again, you can decide that you'd like it a little more rigid, is that the committee has discretion to put something on watch for any reason they deem it's appropriate. So for that reason, we aren't specific in, if these 2 things happen for these 2 quarters, this is the action you have to take, because then if you don't, it raises the question. So I understand the idea of being more specific, so, and I think you can make the case for it. I'm just explaining it to you.
I'm pointing out that it doesn't say that,
Yeah,
and if that's okay, I want it to be clear for all of us that when we're reviewing these things, that we do have that discretion. That we,
my comments were for everybody, not directed at your point there. So I think you could do it either way. I'm just stating why we prefer it the way we prefer it. Maybe you don't. You collectively, I mean.
Yeah. Okay. And then at the top of page 16, the very end of that very first line, it says the committee may perform a manager search. I would rather that it say the committee may replace it, as opposed to the committee may perform a manager search to replace it. How we do that, I think, is for us to decide. We may not want to do a manager search. We may just say, replace it with this other fund. But that's my preference.
What we did today, though, was a manager search, correct?
We did?
Yeah.
I think
It's
we
just
asked.
I think it's just a technical jargon.
Okay.
Yeah.
You're right, both, and I don't think it's a problem to just state replace. You don't have to spell out the process for replacing a fund in here if you don't want to, but the process typically is the manager search, and how you decide to do the replacement is your business.
Rosh, are you able to put your mouse exactly where what?
I'm looking for it. No.
Right there.
It was the top of page 16.
Oh, the committee may perform a manager search to replace it.
Yeah, and I was suggesting maybe the language should say the committee may replace it. as opposed to telling us what process we need to do to replace it.
How many processes are there? I think that's another thing to understand.
The only one I know of.
Okay.
This is Manager search.
Okay.
I mean, I guess you could just go pick a fund. You didn't do a search.
Yeah,
That's not prudent, right?
I can see I could see a scenario where you got rid of the fund and didn't replace it with another fund. You just took the assets and moved it to something else that's in the lineup. Conceivably, that would be, we replaced the fund in the lineup. We removed it and mapped the assets to something else. No search was performed.
It also says may, so isn't that kind of you're giving yourself the flexibility, right? Not shall or will.
Correct. The language is written to provide some flexibility.
And then on page 13,
Can we go back? I don't understand what, can we be more clear on if a motion were passed? This specific sentence, is something actually going to change, or the committee is saying that the sentence provides some flexibility and we want to have that flexibility? I'm not clear on what's being done with this sentence or holistically for the purpose of the policy. Is nothing being done, or?
I'm okay with the discussion that says that we don't do anything, but I wanted to make sure I brought these issues up. I read this, as you can tell, very carefully, because this was our first time in several years to have a chance to review it.
I think it's okay to do nothing.
That's the. I'm almost done. On also on page 13 at the bottom. Let me see. Oh, no. Lost my place. All right. So I'm sorry, on page 16, the paragraph at the bottom, investment oversight responsibility and proxy voting. We talked about using the word options instead of funds. I'm thinking that that very first sentence in the paragraph, the committee shall have overall responsibility for the selection, monitoring, and recommendation of termination of all investment options or investment managers and investment options, because what we've seen from the fiduciary review, there were some articles that were highlighted that talk about it's not just mutual funds that plans are putting into their lineups these days. There are other investment options which we may never get to, and that's fine. But I'd like the language to be able to give us that flexibility. So
I think options is good there.
instead of managers, or
Instead of.
Instead of, okay. So that's it would say recommendation termination of all investment options instead of investment managers.
Is that it, Marie?
I'm checking, Brad, thank you.
Oh, that's cool. Well, I had one, that's why I was.
Okay, I believe that's it, thank you. Thanks for your indulgence.
Thanks, Murray. Go ahead, Brad.
Mine is on page 2, investment consultant, paragraph. It just says the city and committee, and I don't know, when you say the city, it seems a little vague to me. Should it say plan administrator or designee? If you could please weigh in on that. It just seems like, saying the city means it could be anybody. And I think maybe that should be a little more defined and maybe say plan administrator or designee and the committee. Tell me what you guys think. That's my only one, though.
Going up to, oh, shoot.
It's the other one right there.
Yeah, I see
Oh,
that, but
okay.
I'm going back up to.
Oh, I see.
I totally understand your point, Brad. Thank you for bringing that up. I think, you know, we identify the city of Sacramento as the plan sponsor. Typically, I think the language is fairly consistent with how we do other documents when we reference the city.
Sure, I see it a lot in MOUs and stuff.
I'm
yeah.
not wedded one way or the other, as, like, I understand if it's investment, yeah,
Does that mean, though, that anybody, like, let's say the attorney could talk to the fiduciary group? Is that what that means? Or should it just be only the plan administrator talking to our fiduciary advisor?
well, I mean, let's use an example of, right now I have two jobs. I'm
Right.
doing both things. When there's just a director of human resources who council has identified as the plan administrator, typically that position, because it can't do all the day-to-day stuff and communication like with the investment consultant, that person is then delegating some of those things to the benefit services manager to have the routine communication, take back to Rosh and his
Correct.
team and that sort of stuff. So there are instances where no, the director of HR as the plan administrator is not going to be the one having all the conversations. That too is going to get delegated. So,
Right, I just was wondering, should we spell that out, you know, or is just, it just seemed like saying the city seemed a bit generic to me.
Yeah.
You know, and that's all. I mean, you know, because really at the end of the day, all the participants, and don't get me wrong, most city employees are participants, are paying for the consultant. And I just want to make sure that, you know, only the people who should be talking to the consultant are talking to the consultant.
yeah, I like the idea of the plan administrator
And/or designee.
and/or designee.
Okay. I just seemed a little vague to me is all. Thank you.
Thanks, Brad. Anybody else have anything they'd like to contribute or weigh in on?
I took notes of the edits. Do you want me to run them through them unless you did already as well?
I took notes,
You
but
did?
you and I are going to make sure our notes match by the time I
Okay, I'll stop talking,
move
sorry.
this forward.
Do you want us to enumerate the changes in the motion, or I'm comfortable with giving it some discretion to the
Yeah, I mean, I think
and
that
Rosh to figure.
the whole process was to go through the red line version and discuss the changes, and obviously if we found others, we could add those.
I make a motion that we pass the, bylaws, or not bylaws, investment policy, sorry, as with the edits we've discussed at this forum.
Before we do you want to make sure you're on the same page with Rosh so we get all these in as
I've
discussed?
got the, making sure the language is consistent from using, so the word size to cap, right? Identifying if industry standard needs to be hyphenated. We need to add the word provider at the end of the sentence on the U.S. small, on the top of that page, right? It was in blue.
Yes,
Provider. I have, we've confirmed that we're leaving as is the perform a manager search to replace at the top of 16. Page 16, bottom, first sentence of investment oversight, change investment managers to investment options. Page 2, investment, the language surrounding investment consultant is to change the word city to plan administrator or designee. Did I miss anything from what you have
that's
written
exactly
down?
what I have.
Okay.
All right, excellent. So Brad, would you like to make your motion now?
Yeah, unless we have to hear from the public on this.
Oh, true, yeah, is there any comment
always
from the
forget
public?
that.
Thanks, Brad. It's my first day.
Thank you, Chair. We have none.
Okay,
All right.
yes, I would like to make the motion to pass the investment policy with the edits as so discussed in this forum.
Do we have a second? Jeremy with the second. Okay, all those in favor?
Aye.
Any opposed? Any abstentions? All right, excellent. Thank you. Well done, everybody. All right, so our next item is member comments, ideas, and questions. Does anybody have anything?
I have one. I've been on the committee for quite some time, and in that time, the plan administrator has never attended a meeting in person, and today is the first day, and I want to say to the plan administrator, I appreciate.
March, the plan administrator was here.
Oh, okay.
Interim plan administrator.
Oh, sorry, I missed that one. But I want to say I appreciate that you're here as plan administrator.
Thank you, Brad.
Anyone else? All right, do we have an, oh,
Did we specifically not do items 2 and 3? Because they were,
Two
they were on the
and three were
consent.
part of the consent
Those
calendar.
items were placed on the consent calendar as in the interest of time to try to make sure we got through the things that we needed motions passed on today. That's why they were placed on the consent calendar for today's meeting.
all right, do we have any public comments?
Thank you, Chair. There are none.
All right, well, thanks to everybody for coming, and we will see you all in September. Have a great 4th of July.
Thank you all.